October 24th, 1929. A chilly autumn morning in Lower Manhattan. For nearly a decade, the United States economy had been roaring like an unstoppable freight train. Everyone, from elite Wall Street tycoons to ordinary shoeshine boys, believed that the stock market was a magical engine of infinite wealth. But at exactly 10 a.m., the engine violently seized. If you want proof of this illusion, you don't need to look at history. Just look at the world debt clock right now. Those numbers grow by billions every single second. Why? Because the money in your pocket is not backed by gold. It is backed entirely by artificial debt. Without warning, a wave of massive, unexplained selling orders hit the floor of the New York Stock Exchange. The prices of America's greatest corporations began dropping not by cents, but by dollars every single second. Panic, cold and absolute, swept through the trading floor like a physical shockwave. By 11 a.m., the murmur turned into utter madness. Traders were screaming, tearing their hair out, and throwing stock certificates into the air. Nobody was buying. Everyone was running for the exits. By the time the closing bell rang, billions of dollars of wealth had evaporated into thin air. It was Black Thursday, the day the Roaring Twenties died, the day the modern world came to a sudden, terrifying halt. How did the wealthiest nation on earth lose everything in a matter of hours? What was the massive, invisible debt bubble that caused this catastrophe? Today, we decode the dark mechanics of the 1929 Great Crash, the psychological collapse of global capitalism, and the day the world stopped. Welcome back to MONETA. To truly understand the horror of 1929, we must first look at the incredible euphoria that preceded it. The 1920s were a time of unprecedented optimism. America had emerged from the First World War as a global industrial superpower. Factories were working day and night, churning out revolutionary inventions, automobiles, radios, and electricity for ordinary homes. The corporate profits were soaring, and society was intoxicated by sudden wealth. The concept of the American dream was born, and its temple was Wall Street. Between 1920 and 1929, the Dow Jones Industrial Average multiplied by an astronomical 500%. The stock market became a national obsession. Newspapers published stock tips on the front pages. The general public genuinely believed that poverty was about to be permanently eradicated from the human experience. But beneath this glittering surface of champagne and jazz music, a lethal financial cancer was quietly spreading through the foundations of the economy. The massive bubble of the 1920s wasn't built on real money. It was built entirely on a dangerous, unregulated financial mechanism known as buying on margin. In the 1920s, you didn't need to have money to buy stocks. Wall Street brokerage firms created a system where an ordinary investor could buy a stock by paying just 10% of its value in cash. The other 90% was borrowed directly from the broker. Think about the sheer madness of this math. If you had $100, you could buy $1,000 worth of corporate stocks. If the stock went up, you made massive profits on money you didn't even own. It seemed like a foolproof way to become a millionaire overnight. By 1929, global banks were pouring billions of dollars into Wall Street to fund these margin loans. More than 4 out of every $10 in the entire U.S. economy was tied up in speculative stock market debt. The entire financial system was a giant, inverted pyramid balanced on a single, fragile assumption that stock prices would mathematically go up forever. But in the shadows, corporate production was slowing down, inventories were piling up, and the smart money was already quietly heading for the exits. By October 1929, the tension was palpable. A few minor drops in September had made nervous brokers realize how exposed they were. They began issuing margin calls, demanding that investors immediately pay back their borrowed cash. But the investors didn't have the cash. The only way to pay the debt was to sell the stocks. The real catastrophe struck on Tuesday, October 29th. Black Tuesday. The market opened to an absolute bloodbath. There were no buyers, only a desperate, frantic ocean of sellers. Major industrial titans like General Motors and U.S. Steel saw their values cut in half in minutes. The ticker tape machine, which printed the stock prices, fell hours behind because the volume of sell-in was too immense to process. Investors were completely blind, throwing their shares into the abyss at any price just to escape total ruin. In a single day, over 16 million shares were dumped. The financial heart of the Western world was completely obliterated. By the end of that week, $30 billion had vanished from the economy. The illusion of eternal wealth was shattered, and the cold, brutal reality was about to set in. But when they arrived, the doors were locked. The tragedy of 1929 didn't stay on Wall Street. It quickly marched down Main Street, destroying the lives of millions of people who had never bought a single stock in their lives. Because banks had used ordinary citizens' life savings to fund those risky margin loans on Wall Street, the banks were now completely bankrupt. Rumors spread like wildfire. Millions of terrified citizens rushed to their local banks to withdraw their cash. But when they arrived, the doors were locked. Over 9,000 banks collapsed across America, wiping out the life savings of millions of families overnight. If you had saved money for 30 years, it was gone in an instant. Factories closed their doors. Businesses went bankrupt. Within months, 1 out of every 4 American workers was completely unemployed. Men who were once proud corporate executives were now standing in mile-long bread lines just to feed their starving children. The Great Depression had officially begun, and it would hold the world in a death grip for an entire decade. The Great Crash of 1929 stands as a stark, timeless monument to the danger of unbridled human greed and artificial debt. It proved that when an entire economy stops producing real value and instead starts trading illusions and borrowed money, a catastrophic collapse is mathematically inevitable. The names of the stocks have changed, the technology has evolved, and the trading floors are now digital algorithms. But human psychology and the mechanics of market bubbles remain exactly the same as they were in the autumn of 1929. History has shown us time and time again that the loudest market booms always precede the quietest, most devastating crashes. The question is not if it will happen again, but when. If you want to protect your financial future, decode the true history of global wealth, and understand the hidden forces that rule our modern world, make sure you stand on the side of knowledge. Subscribe to MONETA, hit the bell icon, and join us as we uncover the secrets of the global financial elite in our next chapter. Thank you for watching.